Good morning and welcome to our Hey David, What's Going On with the Mortgage Market webinar with David Luna. I would like to introduce you to the President of Cant, Ms. Audrey Boston. Audrey?
Good morning, everyone. Thank you so much for joining us today. And thank you so much to Dave Luna for being our inspired guest. We always look forward to hearing from you, Dave. Just wanted to also mention that Kevin Casey is on the line. He is our president-elect for California, and he will also be chiming in today. A few things. We have a webinar scheduled for Friday morning. It will be an appraisal panel with 3 of our industry leaders in the appraisal business. So you'll be able to ask questions and they will be doing a presentation. So obviously appraisals are a big issue right now. So that will be very informative and helpful. We'll be sending out the information about that shortly. And it's membership renewal time, so make sure that your camp membership is up to date. And with that, I want to welcome Dave Luna, who really needs no introduction. He is such an icon in our business and such a wealth of information. So David, welcome to our meeting this morning.
Oh, thank you. And good morning, everybody. How's everybody doing? And again, over what we're overcoming and struggling with, I hope that everybody is doing very, very well. So Audrey and I were talking this morning about maybe making this a weekly thing. So what we're going to do is I'm going to ask for your questions, and it's okay if you give me technical questions. What we're going to do is we're going to do a Q&A. Today, I haven't really prepped you for anything, like Q&A. So if we have some questions that we have time to get to, we'll do that. But let me just go with what I've already prepared. And let me just first start off with telling California, we're great here in California. 25% of mortgage lending in America comes from California. So California will play a huge role in helping America recover from all of this stuff that's going on. So I want to also let you know the information I give you today is 1 week old or less. There is so much information. I don't want to repeat stuff that's already been said. And I'm also talking to some of the greatest minds in America as it pertains to the mortgage business, like Barry and Rob Chrisman and everybody else like that. So to start off, we see that the government is trying to step in to solve the mortgage issues regarding appraisals and verbal VOEs. If you saw the mortgage e-letter dated March 27th from HUD, it's 2020-5 for FHA and VA loans, and Fannie and Freddie's LL 2020-3 through 5. They're talking about appraisals are okay if we just do exterior or desk reviews. So there's a little bit of help coming over to the front lines. I know some of you guys were saying, well, Dave, how do we do appraisals if they don't let the appraiser in? And again, Audrey just said it on Friday, we're going to have other appraisers tell us what they're doing. So I'm going to leave that for Friday. So an important note is these are only temporary changes, good until May of 2020. Now that's a hint of what I'm going to tell you that's going to happen in the future. Okay, so this coronavirus, as it pertains to the mortgage industry, I do not see lasting longer than 2 months. And I'll give you a little bit more insight later. For some of you guys that are brokers, because I know we have LOs and brokers, from the NMLS posted 325 in response to COVID-19 pandemic, the NMLS has implemented a 60-day deadline extension for the MCR, or the mortgage call report. So you don't have to worry about that because you have a lot of other things on your plate that you have to worry about. So I think the biggest question that we've been getting is what is going on in the market and what's been happening to pricing. Right before we went on the air, our president said, Dave, I used to watch the 10 years to see what the heck is going on. And right now it's a little bit fruitless because what you think and what you've known for years and years and years has just been thrown out the window. So I want you to understand that the Fed has been purchasing mortgage-backed securities, or MBSs, causing their price to rise dramatically. Now this causes the lenders' hedged short positions of MBS to show huge losses, but that's only half the picture. These losses appear to be offset, at least on paper, by the potential market gains on the loans that the lender hopes to close in the future. So that's why you're seeing some things go away. Like, for example, we used to have locks and we could time the locks, and you see that timing has now been totally changed. So you also now have a new component the industry may not be aware of called a broker dealer. The broker dealer will not wait on the possibility of future loans closing and demands an immediate margin call. Now, depending on the size of the lenders, these folks are paying millions or tens of millions of dollars in margin calls. So on top of all of these stresses that the lenders are having to endure, the market for jumbo loans and the market that don't fit ideal parameters have all but dried up. The non-QM market effectively has shut down this week as many investors stop taking in new applications and funding loans or asking for ridiculous conditions at the last minute. Now, I'm involved in a couple of mastermind groups, and I'm seeing things like, well, you know, we couldn't quite really make out the picture and the name and the address on the driver's license. So, I mean, really, really ridiculous conditions. And this is the day before closing, okay? So you're seeing a lot of new changes going on that we haven't really seen in the past. So, okay, so let's say the loan closes. So if the loan does close, there are no buyers at the rates that the loans were originated. So anything that is sold will be done so at prices much lower than par. Now, as reported this week by Bloomberg, Angel Oak Mortgage Solution last week laid off nearly 200 of its 275 employees. The market is also affecting others such as Wells, Redwood Trust, Citadel, Impact, Sprout, Deep Haven. Those that are offering jumbos, the big banks, what they're doing is they're not turning around and selling them. What they're doing is they're keeping them in their portfolios. So the top 5, Wells Fargo, B of A, Chase, US Bank Home Mortgage, and First Republic Bank, they're originating jumbos, but they're keeping them all. All right, so let's talk about what you guys, you guys are asking really, really cool questions. And so let me kind of respond back. Dave, is this like 2008? Well, there's one thing that's like 2008, and it's the Financial Stability Oversight Council, mouthful. What it was set up after the 2008 financial crisis. Now, last Thursday, so just 4 business days ago, last Thursday, those on the council had a call. Now, let me tell you some of the people on the council. It's Federal Reserve Chairman Jerome Powell, Securities and Exchange Commission Chairman Jay Clayton, and FHFA, the Federal Housing Finance Agency Director, Mark Calabria. FHFA, of course, is the regulator over Fannie and Freddie. Now, mortgage servicers face potential stress because FHFA and lawmakers are granting forbearance. You should have seen all over the news forbearance, 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 or the skipping of payments for homeowners who can demonstrate financial hardship due to this virus. So Dr. Calabria said that a lot of mortgage servicers could find themselves at risk of collapse if the coronavirus pandemic lasts for more than 2 months. So here's the problem, and possibly a solution. I'm going to tell you how the mechanics work, and I try to explain things in English so people understand. So I'm going to slow down a little bit. I tend to talk fast. I'm going to slow down a little bit because this is super, super important for you guys to understand. This is a little bit of good news of problems and what's going on and how do we solve it and things like that. So many mortgage lenders hedge their pipelines by taking short positions in the to be announced agency MBS market. So think of a little bit of Vegas, except you're not only going on red, but you're also placing money on black. So sometimes you might win in red and sometimes you might win on black. So lenders are covering their bases with, short positions, all right? Now, because loans in pipelines could fall in value prior to the sale in the secondary market, say interest rates go up, lenders often seek to hedge this risk to avoid losses. So one hedge entails taking a short position in the TBA securities. When interest rates rise, the lender will suffer losses, but it'll gain on its hedge, and vice versa when interest rates fall. So again, they're trying to cover their bases. So now let's see what happened over the last week. Agency MBS valuations rose dramatically. Now, while lenders can expect to recognize gains or interest on their pipelines, they're also going to realize or recognize losses on short TBA positions that they use for hedging purposes. Now, these pipeline gains will be recognized over a period of time, say weeks, but the sharp movement in hedge positions typically entails daily adjustments and a really, really bad thing called margin calls from their broker dealers. Now, because of these dramatic changes, broker dealers' margin calls on mortgage lenders reached staggering and unprecedented levels by the end of last week. So for a significant number of lenders, many of which are well capitalized, these margin calls are eroding their working capital. So think about it. Millions and tens of millions are going to these broker dealers, and it's threatening the lender's ability to continue to operate. So I'm not saying that they're in a weak position, but even lenders in a strong financial position only a few days ago will not be able to meet these margin calls after market movements at the pace observed last week. So let's hope everything tends to settle down a little bit. So recently, many financial regulators have emphasized the importance of working with customers in response to the COVID-19 outbreak, such as forbearance or skipping or missing payments. Now pretend you're a lender. Let's pretend you're a lender. So your customers, the people that have mortgages, are hearing, hey, you can skip or miss your payments. You're going to ask for forbearance. So again, the lender is not receiving that income. 2, lenders still have to make payments to investors with money they're not getting. 3, they're having their margins called on income they don't have or won't receive today, and depending on how many payments are missed, they may not get for a few months. Okay, here's the problem. What's the proposed solution? So remember that call last Thursday. Remember the SEC was on that call. So FINRA and the SEC should issue guidance to the nation's broker dealers, making it clear that margin calls on mortgage lenders at this time are really exacerbating the problem. TBA hedge positions should not be escalated, especially right now. Now, absent such guidance and an immediate shift in broker-dealer practices, the U.S. housing market is in danger of large-scale disruption. I don't mean to scare you. What I'm trying to do is give you information so that you better understand what the heck is going on and why it's going on. So you're saying, well, Dave, I can't really lock the way I did in the past. That's correct. Well, Dave, I can't really lock until I have like a clear to close. That's correct. What we're doing is we're removing that hedge instability if we can pretty much know for sure what loan is going to close instead of what loan is floating out there with, with this lock on it. So what lenders are doing, because again, the SEC hasn't had this conversation with broker dealers. Hopefully that'll happen since last Thursday. Maybe we can give you an update next week. But you should be seeing a more conservative LTV change. I mean, I can't see you. Raise your hands. Are you seeing more conservative LTVs? And are you also seeing that credit scores are going way, and I mean like way up? Some lenders in the past that are sitting there saying, oh yeah, we'll go to about 500 FICO. Yeah, right. It's not 500 at all. It's not even close to that by 100. 640, 660, 680 is what I'm seeing around the country. Now, because of the market changing so quickly, you're seeing all of these changes by the lenders because they are just trying to hedge what is out there. Now, I want to stop on that one. I'm giving you information overload, don't mean to, and I think I'm still talking fast again. And maybe at the end of this visit that we have, you guys can give me some of your questions. I think Audrey or Kevin can relay some questions. But let me just talk about some other things that are going on. Hopefully you guys are learning something. So you have Senate Bill 3533, the Secure Act. It's called Securing and Enabling Commerce Using Remote and Electronic Notarization Act. So an electronic notary would sure help. We talked about that the appraisers can now do an exterior, and then lenders can do a desk review, and hopefully we're getting more PIWs and ACEs, though I'm getting some feel that that's not really happening, where you don't even have to do an appraisal at all. But anyway, there is an immediate need to provide an alternative method of doing that notarization from a remote location. It's called RON, Remote Online Notarization. So the Senate is working on it on the Senate side. The House is also working it on the House side. It's called 6364. Giving the ongoing pandemic current requirements for a signer to be physically present in front of a notary is nuts, and it's in conflict with Governor Newsom's orders stressing you got to shelter in, at home. You got to avoid unnecessary conduct. You got to keep that social distance. Well, how in the heck can notaries do that unless we have a solution? And again, it isn't just California, it's a nationwide solution. So, that's working its way through Congress. Now let's talk about something that worked its way through Congress that we saw, finalized on Friday. The $2 trillion stimulus bill called the CARES Act. Now that passed on March 27th, 4 days ago? It's the third stimulus package, and Congress right now is prepping for the fourth stimulus package. Part of the problem and part of the solution. Right now, it's a bigger part of the problem. Let me tell you what's going on. So part of the problem, okay, it's a feeling that's being created that's making the mortgage problem worse. Well, what does that mean? Everybody on the news, we've got this 2 trillion thing and we're going to send money and it's all going to be good. And now people are going, well, then is this worse than what I thought it was? Are they throwing money at the mortgage problem, and therefore broker dealers are going, well, I didn't think it was that bad. I thought it was going to blow over, but they're throwing all of this money at it. Should we be calling, these margins due? And because of all that uncertainty in the market, that's why you have jumbo and non-QM in trouble. So far, the government solution only addresses the most common types of loan. So FHA, VA, Fannie, Freddie, the most common is what you're seeing. And so far, there's been no thought, and no one is backing or will back jumbo and non-QM loans. Therefore, the question is, what are they worth? Nothing in the stimulus package protects or covers warehouse lenders, so that money is also drying up overnight. What does the stimulus package then do? We were talking about, solutions and problems. The stimulus package does provide $454 billion in loans, loan guarantees, and investments for the purposes of providing liquidity that supports lending. Now, this funding will enable Treasury and the Fed to establish a liquidity facility for loan servicers to access for advancing payments. We'll talk about that one in just a little bit. Consumer right to request forbearance. It applies to federally backed loans that we just talked about, Fannie, Freddie, FHA, VA, USDA, for those directly impacted by the COVID-19 virus if the borrower requests and affirms hardship. No signature, no documentation is required, and the initial period is up to 6 months with the option to extend for up to an additional 6 months. That should be a new number for most of you guys. A moratorium on eviction. So for 120 days after date of enactment, which was last Friday, for single family and multifamily properties that participate in federal housing, homelessness, rural programs, properties financed by federally insured or guaranteed mortgages, including mortgages purchased or securitized by Fannie and Freddie, those have a part. Now, the Washington Post did a calculator that I thought was kind of super cool. So if you want to know, or your borrowers want to know, well, how much money will I get? Just look up the Washington Post graphics on the coronavirus stimulus check. It's a calculator. You put in what your either single income is, or if you're filing jointly, what your joint income is, and it'll tell you how much you're making. But if you're single, 99,000 or less, okay, you're probably going to get some sort of a check. The more money you make, the less amount it'll go to. Again, you see that there is nothing happening for jumbo and non-QM. Now let's bring it back to California. We know that President Trump approved a major disaster declaration for California. I mean, think about it. FEMA, president, disaster in our state. So on March 22nd, FEMA announced that the federal emergency aid has been made available for California and the areas affected by the coronavirus. Now, 3 days later, Gavin Newsom announced on March 25th that financial institutions will provide major financial relief for millions of Californians suffering financially as a result of the COVID-19 breakout. Our hearts go out to those millions that are affected. Again, I have a daughter that's battling cancer right now, going through chemo. She has no immune defenses. She can't even get out of the house. Her husband can't get out of the house. And so I know for you, as equally for me, it's affecting all of us. Going back to Governor Newsom, quote, millions of California families will be able to take a sigh of relief. These new financial protections will provide relief to California families and serve as a model for the rest of the nation. He says, I thank each of the financial institutions that will provide this relief to millions of Californians who've been hurt financially. Governor Newsom secured support from federal and nearly 200 state chartered banks, credit unions, and servicers to protect homeowners and counselors. We have to protect them, but we also have to protect the lenders that are also making payments, right, on money they don't have. So under the governor's proposals, Californians who are struggling with COVID-19 may be eligible for the following relief. 1, a 90-day grace period for mortgage payments. So financial institutions will offer mortgage payment forbearances of up to 90 days so that borrowers affected economically by 2019 won't lose their home. In addition, institutions will provide borrowers a streamlined process to request a forbearance. There's an approval process, and it will provide borrowers the opportunity to request additional relief, showing hardship that they're going through. Now, when I did a Facebook Live event, one of the questions that we got was, well, Dave, will this show up on the credit report? Wow. Okay. Financial institutions will not report late payments to credit bureaus for borrowers taking advantage of the COVID-19 related relief. I talked to a dear friend of ours, we'll just call her Michelle, who was talking, just not that she's in trouble or anything, but just trying to figure out to help borrowers understand. She's a loan officer. They said, sure, you can skip April, you can skip May, you can skip June. And in this example, let's say the payment is $4,000 a month, but on July 1st, you'll need to pay $16,000. Now that was an example of one servicer. Other servicers are taking the skipped payments and then putting them on the end of the loan, which makes a lot more logical sense, because if they had the $4,000 to pay up front, say on April 1st payment, then they would have made the payment. So what makes lenders think that on July 1, they're going to have 16 grand? See, that just doesn't make sense to me. So as you're visiting with your borrowers, you may ask your borrowers to contact their servicer to see what they're doing, and maybe get back with us information that we can share with the state on next week's update. So there's a moratorium also for initiating foreclosures for at least 60 days. They won't initiate foreclosure sales or evictions. So let's go back to something I already mentioned. So what happens when a borrower can't make their house payment, yet the lender must make their payment to the ultimate investor. Now, this comes directly from Jenny Mae, and this is March 27th. Remember, everything that I'm sharing with you is only days old. It's not even a week old. So if you look at the calendar, this is only like, again, 4 days ago. So this came directly from Jenny. So let me do the quote. Jenny Mae has authority to make changes to the requirements of our program, and we are using those powers to tailor the existing disaster pass-through assistance programs to more suitably scale to the needs of this national emergency. Jenny Mae continues. Jenny Mae fully anticipates implementing within the next 2 weeks an all participants memorandum. We'll call that an APM. A pass-through assistance program, we'll call it PTAP, pass-through assistance program, through which issuers with a P&I shortfall may request that Jenny Mae advance the difference between the available funds and the scheduled payment to the investor. Hopefully you guys understood that. What that means is if the lender does not have enough money to pay the investor, Jenny Mae says, okay, we will make up the difference, but lender, it comes with strings. So let's continue on with what Jenny is saying, and I'll interpret it in English. This PTAP will be effective immediately upon publication of the APM, All Participants Memorandum, for single-family program issuers. In return, for any payments advanced under the PTAP, issuers will be required to sign an agreement with Jenny Mae and must repay the advance within a specified period of time. So again, lenders are okay with that because they will realize, payments and profit and income. Again, they're not charities, but they're just saying, let me not do that today. It's kind of like you with your credit card. You need that refrigerator. You need, whatever it is that you need, but you don't necessarily have all of the money today, but you have a job and you're working and you're going to be able to make the payments. So you take out a credit card and you buy the refrigerator today and you put your food in and everything's cool, but your ongoing job will help you make the credit card payments. This, on a much grander scale, is what Jenny Mae is saying. They're saying if you can't make those payments to the investors, we will cover it. However, you're going to need to pay us back. And the lenders are like, cool, we can do that. We have loans, we have money, we have payments. This thing's not going to last for forever. So yes, we will pay you back as soon as we start realizing some monies. So the agreement with Jenny Mae will provide for extension requests and specify the rate of interest that will apply to the borrowed advances. FHFA Director Calabria said that as the economic fallout from the coronavirus continues, the agency might have to seek help from Congress or the Federal Reserve to support the GSEs, Fannie and Freddie. Remember, they were trying to accumulate money so that they could be brought out of conservatorship. So that hasn't happened yet. It was on track, and then boom, we have the coronavirus, and everybody's world should have been turned upside down, 3 weeks ago, right? So it's been a lot of doom and gloom and negative info. So on a happier note, I want you to see what the heck is going on in the stock market. From Tuesday to yesterday, and again, today it's kind of deciding, are we in negative territory? Are we in positive territory? So right before we went on, I checked again, and it's just still teeter-tottering right on the edge. If you look at from last Tuesday to today, last 7 days, that's all this presentation today is about, is the last 7 days. From Tuesday to yesterday, heck, even including today, the Dow Jones Industrial Average rose over 20%. Now, if you don't know what that means, that's signifying the beginning of a new bull market after just 11 trading days in the bear market. The Dow has had its best week since 1938. That isn't good news. I don't know what is. The S&P 500 has risen more than 17%. The NASDAQ has bounced back more than 13%. Now, instead of just getting all this info from Dave, let's bring in other folks, like, for example, the vice president of trading and derivatives at Charles Schwab. He says the markets are playing chess. The markets and the economy don't run parallel. The markets don't care about what's happening today. The market cares about what's happening 6 months from now. So what is the market seeing? I mean, look at all the positives. I think they're seeing a ray of sunshine, just like my blinds are blinding me because of the sun. I think they're seeing a ray of sunshine. As we start to get our arms around this COVID-19 challenge, yeah, the US will be seeing a turning point in the battle to contain coronavirus sooner than expected. Dave, you're not a medical person, and ladies and gentlemen, no, I'm not. But this is according to the Nobel laureate who correctly predicted when China would get through the worst of its crisis. And it's also another Californian, Stanford University biology professor, Michael Levitt, who won the 2013 Nobel Prize in Chemistry. He said his models don't support predictions that the virus will wreak havoc for months or even years. Okay, and that's according to the LA Times. What we need is to control the panic. We're going to be fine, assured Levitt. And I absolutely agree. So I told you since 2017 what was going to happen. And it's really, really cool that some of you guys are sitting there saying, Dave, you called it. And that was years before it happened. In 2018, I did a published article that you can't change because it's now published, right? In National Magazine telling you what was going to happen. I did not and couldn't have predicted the coronavirus, okay? And so I was off on my quarter as to when we would go into a recession. Ladies and gentlemen, we're in a recession right now, whether they want to call it that or not. Just look at all the slowdown, the unemployment. I mean, we went from a sprint to a stop that fast. So if you're looking for a future prediction from me, let me tell you, it'll be challenging for the next 2 weeks to 2 months. However, the industry will be back, and I mean like full steam, before the end of this year. Well, Dave, I mean, we've only got like months left. I know. So the next 2 quarters, yeah, my crystal ball is a little foggy, even though I did change the batteries in it. Honestly, truthfully, I'm looking at third quarter, fourth quarter being absolutely amazing, and you are still going to have a record growth year in the mortgage industry, and you will be seeing 30-year fixed interest rates below 3%. So when it happens, would you kindly send me a note and say, hey, Dave, you called it? Right now, amongst all of the mess, it's kind of hard to see, but really, honestly, truthfully, yeah, the models that say this thing is going to be super, super bad, and folks, it is bad. It's just not going to go on for forever. And the market, the basics, the foundational pieces in the market are still there. And so, guys, it's not going to be bad. It'd be bad for a short period of time, but it's just not going to be bad long term. And with that, Audrey, I have been going like for a half hour straight without even a drink of water or a break or a breath. We asked the audience if they had questions to maybe shoot them out to us, and hopefully not super specific questions, but questions pertaining to, generally what's going on in California or the country or the mortgage industry. So do we have any questions that maybe we could go answer right now?
So first of all, I'd like to say that I don't think a half an hour without breathing or drinking for you is a record necessarily. So, but go ahead and take a moment while we do have a bunch of questions. And let me start with the first one said, Dave, we love you, in capital letters, LOVE. You have the exceptional ability to explain complicated things in plain English. Thank you for all you do, my man. And then a smiley face, sort of. Anyway, wow. So thank you. We love you too. So let's start with, we do have some good questions. Let's start with the IRS in what about 4506Ts? So I know that I've seen some published rules around this, but what do you know about how different places are handling them?
It's more than just the 4506T. It's the IRS's system. But Audrey, I'll
Yep.
let you go first. We'll share the microphone for us a little bit, and I'll just defer to you, and I'll jump in after you're done.
Well, so I got some guidance yesterday that said that Fannie Freddie was not requiring them right now. You have to show that you've ordered them, but you don't necessarily have to have them in the file.
That's
And
exactly
we're
correct.
we're waiting for the jumbo lenders to weigh in. So, for instance, PenFed is allowing something similar, but the other jumbo lenders have not chimed in, which leads lenders to require them until they hear something otherwise. So it sounds like if you have something other than Fannie Freddie, it's on a case-by-case basis, and you'll have to check with the investor. Is that what you think?
It's going to melt down to the investor, the lender, and we all in this
Mm-hmm.
industry know about lender overlays. So on lender overlays, it will be investor by investor, and it kind of depends on how much money they have and whether their margins have been called. Are their warehouse banks still lending to them? I mean, even today, I saw announcements, I'm not going to mention any names, that the warehouse lenders are saying, I know we have a contract and I know we're supposed to give you money, but we're just not going to give you any money right now, and we are not honoring our agreements. So you have lenders that are saying, oh my goodness, what the heck can I do? How do I do this? Oh, wow, I don't have a 4506T. Well, shoot, we can't verify the income. How do we know that they're not unemployed? How do we know? And so you have these breaks being put on in the industry. But overall, yeah, temporarily, again, everything that I'm seeing shows a March 17th, 2020 date, a March 25, 2020 date, May 25, 2020 date. So everything is just temporary for the next 2 months.
Yep. And as with everything, we all should know, and it's never a bad thing to be reminded that you have to check with your investor that you're working with or your lender every time. Don't ever take something that you hear on a webinar or in a meeting or from somebody or written on a bathroom wall as the gospel truth. You always have to double check with whomever you're working with. So, and the rules are not blanket across the industry. So people take this guidance and do what they will with it. Right, Dave?
Right. Absolutely correct.
Okay, so I just want to go back. Did I hear you say that there are no call reports that are due right now? Is that what you said, or did I mix?
That's not what I said. That's what the NMLS said. So on
perfect.
NMLS is still alive and well and issuing all kinds of changes. But remember, you have President Trump, who's over, everything, and you have this terrible virus going on that's affecting everybody. And so they're sitting there saying, hey, if you don't have to file your tax returns because we're going to give you extra time, you have a entity, the NMLS, that has also said, you know what, mortgage call reports, So if you actually go to the NMLS website, you're going to see on March 25th that NMLS has implemented a 60-day deadline for MCRs or mortgage call reports, saying, guys, you don't have to send these in. You do have to eventually send them in, but you have 60 days. Notice how everything is 60 days. Notice 4506Ts, notice exterior appraisals, notice everything is 60 days. So I'm looking at all of this info going, nah, we're going to be out of this in 60 days.
Okay, good. So again, it's not that they don't have to do them. It's just that there's a little reprieve on time.
Correct, because we're all managing a whole bunch of other stuff.
So we had a question from somebody who is asking, what triggers a margin call from a broker-dealer? Do you know the answer to that?
Yeah, if the broker-dealer is feeling very, very nervous that the lender will not be able to make the payment because they can't predict what's going on in the future, remember, the stock market is not reacting to what's going on today. They're looking down the road. And here's people that have their money, not in a checking or savings, but in the stock market because they're hoping to get a better return. And they're not trying to figure out what's going to happen an hour from now. They're trying to figure out, okay, what's going to happen a little longer term. So if the government, and that's part of the problem, if the government is saying, we're just going to throw a whole lot of money and we're just going to protect these people, they're looking at the list and saying, okay, who's protected? FHA, VA, USDA, Fannie, Freddie, where's Jumbo? And Jumbo's not there. Where's non-QM? Well, non-QM's not there. And so they're sitting there saying, well, wait a minute. So when you saw, and I feel really bad for the people that were at Angel Oak that, got let go. Hopefully it's super, super temporary, or others out there. And I know there's others that are saying, hey, we're doing non-QM and we're still alive and well. And you know what? Cool, great. If they're portfolioing their product, they're keeping it in-house, yeah, they don't have the possibility of these margin calls. But if they're sitting there saying, well, the money was used for these kinds of loans, jumbo non-QM, and there's no backstop, there's no support, what the heck is this thing worth? At what interest rate? And because they're feeling nervous, they're saying, no, 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 no. Lender, you got to pay me, and you have to pay me right now. Okay, stop. You have a very, very large lender that kicks out $10 million, and the broker dealer is like, okay, I feel better. But let's take a smaller entity where they say, okay, I need a check for $5 million. And the lender is like, that pretty much wipes out our operating capital. And they go, not my problem. And so they're thinking, is the lender going to default? So it's all a matter of nervousness. If the federal government would be a little bit more specific and say, we're going to cover these as well, then I think there would be a little bit more of a relief in the marketplace, instead of saying, hey, we're not doing anything for 2 weeks. Hey, we're not doing anything for a month. And you guys from your, wholesale account executives had seen those. Hey, we're not going to do anything, or heck, it might close and we're not going to fund. I mean, it reminds us of 2008, right? So if the federal government could be a lot more specific, we're going to cover all of these people. It won't even be 2 months. It'll be less than that. But that's not what's coming from Washington right now. So anytime there's nervousness, boom, those margins are being called. The lender either can or cannot pay it. If they can, they're paying it, and hopefully, more income is going to come in. If they can't pay it makes that broker dealer even more nervous, saying, see, I saw it, I knew you were in trouble. And so they go to their warehouse bank and say, okay, I need to access my line of credit. And the warehouse bank says, nah, I don't think so. Do you see everything that's going on? It all escalates. It's either going to blow up or it's not. My opinion, I don't think it's going to blow up, but there could be some repercussions in the industry.
Okay, so if that would speak to one of these questions, which is, do you see the non-QM market coming back, or is it gone forever?
No,
and if so, if you...
No, go ahead.
Oh, I was just going to say, and also, jumbo. They're also asking about jumbo. And by the way, there also is a well wish in here for your daughter's full recovery. So I want to make sure that you hear that.
Let's do the most important one first, is our daughter. So non-Hodgkin's lymphoma, stage 1, good and bad. Her and her husband don't have any kids, so I don't have any grandkids from those guys. But it happened so quickly that she didn't have time to freeze any eggs. The treatment looks like it's going to be, like, she's going to be fine. But after all the chemo, then she's going to go for day after day after day of radiation. And sometimes, guys, that does things to your body. Anyway, the prognosis is she will be 100%. And so for whoever said that, love ya. I hope you and your family are doing well. Okay.
I think we're getting a number of well wishes for you and your family. So it is not, you have a lot of love out there, Dave, for both you, Kimmy, and your whole family.
And by the way, Kimberly's here.
I know.
Whenever I do,
she was supposed to text me a picture of herself so I could look at her cute little face.
My super sweet wife is always with me. We're just a pair. You get one, you get the other. And again,
yeah, we know.
Step up, and I'm like the B team, A team, B team, star, janitor. So anyway, we appreciate all the well wishes from everybody. Back to non-QM. Is it dead?
And jumbo.
No, non-QM is not dead. They're taking a little bit of breather. They're trying to gather their resources. Again, guys, give it 60 days. Honestly, truthfully, I think we'll see non-QM back in 60 days. And those of us that have been around for a long time, I've been in this business for 40 years. those of us that have been around for a long time are seeing creative things happening. For example, you can't do a jumbo loan. So what I'm seeing happening is you have lenders that will go, okay, so let's go to the conforming max loan amount that we can go conforming, and then we'll bolt on a second mortgage for the difference. And I'm sitting here thinking, wow, that's brilliant. So the borrower gets their loan. It isn't all in one jumbo at the lowest interest rate, but you know what? In this environment, I get to close and I get to close now. Cool. So conforming for the first part of it, a bolt-on second for the total amount, and you have a combined first and second. And you know what? That isn't rocket science. We've seen that before. So industry is very intuitive, very adaptive, very smart. They're going, hey, there's more than one way to put this loan together, and this is what we're going to do. So anyway, yeah, that's what I'm seeing going on in the industry right now. I'm not going to name names of companies. This isn't a commercial, but just something to think about that you might want to take back to your AE. Hey, can I do, first and second combined purchase? And you might be surprised. You might find an appetite for that out there.
Well, and I'd like to say there are some jumbo lenders who are still in business, not just the big banks, just for the record. So, make sure that you're checking your resources, and not you, in general, people should check around. I mean, we all have to do our jobs, which is we should be looking to see what is available. And that's one of the things we're doing on the Camp website that we are just about to get off the ground, which is we want you to chime in with what are you doing? It's like the opposite of the inflotometer, like not who is gone out, but who's here and who's doing loans and which loans are they doing and which experiences have you had, et cetera. So we're just getting that going on the Camp website so that people can keep track of that. And we invite our lenders and vendors to chime in with what are you doing? What's good? What is good?
Solve this. We're going to solve it, but we're solving it together.
Yes, and I'm getting emails from our lenders who do those HELOCs and things that you can combine with your first so that you can get your loans closed if you need to. So maybe you could call Fannie and ask them to get rid of that LOPA on the second position stuff. So anyway, okay, let's keep going. So longtime listener, first time asking a question, they want to know if you're, and I'm just going to read this. If you're an approved broker in California, you can get approved to lend in other states just by applying with NMLS. Is this true? Really true and that easy? What am I missing? I know in California as a broker, you have to be approved with DRE. Is it the same in other states like Florida and New York? And funny, Anthony and I were talking about this earlier. We are going to put together some classes for other states through Camp. So talk to us, Dave. Tell the people about what you guys do.
Okay, so the SAFE Act was modified November of last year. So this is federal law, and federal law now has 3 categories of mortgage loan originators: a registered loan officer that's at a bank or credit union, a licensed mortgage loan originator, and one who has temporary authority. So can you apply in all 50 states? The answer is yes, if your company is already approved and licensed to do business in that state. So I did a class for a national company, and I am now contradicting what their company was telling them, and they went back and checked and they went, oh wow, Dave, you were right. So if your company is licensed, I think that specifically they said Florida, and I'll pick Texas,
New York,
I'm just picking states, right? So if your company is licensed in those states, you don't have to pass a test, you don't have to do PE, you don't have to do CE, you don't have to, whatever. You don't have to jump, you do eventually have to jump through those hoops, but you apply for licensure at that state and you can start to practice. Well, Dave, for how long? 120 days. Well, Dave, what if I don't get approved? Well, then you better stop working, but something's going to happen in 120 days. 1, you will either get your license for that state. 2, you'll be denied licensure from that state. 3, you'll change your mind and you'll take back your application. Or 4, the state may have more questions. If the state has more questions, it could take actually longer than 120 days. But anyway, you can start practicing in that other state. The second part to the question is, well, Dave, I'm a broker in California and I have to go through the DRE. Well, stop. In California, you have two regulators. You have the DBO and the DRE. So in one of them, you have to be a real estate licensee to get your endorsement, but on the other one, you do not. So now let's go to other states. Other states don't have two, well, there's 5 states that have 2 regulators. But anyway, when you go to another state, you just go with whatever that regulator is asking. Now in California, we call it a broker. But in another state, say Hawaii, it's called a QI, a qualified individual. Or you could have a PLM, a principal lending manager. Or you could have a RI, a responsible individual. So the term broker does not exist nationwide, that if you're a broker in one state, you have to be a broker in another state. That's not realistic. That just happens in California. So if you have, say, approximately 3 years experience or more, you generally could be that person, that responsible individual for another state, whatever the state calls it. But can you go from state to state to state to state to state? The answer is yes, and it's been much more easier since the end of October of last year. Also for bank loan officers, if you're recruiting bank loan officers, the bank loan officer can just start immediately. They don't have to pass the 20-hour. They don't have to pass the test. They don't, guys, eventually they'll need to do that, but they have 120 days to do that. So if you want to get a loan officer from a competing bank or credit union, and yet they don't want to leave because they want to have everything done, they don't have to do that. So the law, again, it's the law. The SAFE Act was changed to make it easier for those folks to migrate from depositories to a license structure.
So to recap, we'll be highlighting those out-of-state licensing opportunities, and also we were talking about, and we'll have scheduled in the next couple of days, having a 20-hour class online set up. So watch for what's coming next, because we have a bunch of things that we're working on. Okay, so there are a bunch of questions on this whole credit issue, and it's getting into the weeds, but you can tell these are like smart LOs who've been doing this a while, because they're asking good questions. So A, will it say forbearance on their credit report? B, do you think that people?
There won't be any kind of rating at all.
Okay, so they will be able to refinance then after this whole thing. And then also, so they were saying, someone was asking, and then there were like 3 or 4 separate things on this, so I'm kind of blurring them all together. But how would the agencies report it? Will it say 0? Will it say, no? So it won't say anything. There will be no indication that they were late.
Correct. That's the information that we have right now. Again, we're kind of trying to forecast the future, because so far it hasn't been granted to anybody. So far they may have requested, but their payment maybe was made at the beginning of March, but now they're unemployed, and haven't helped the 3 million, the 3.285, whatever the number is, million people that are now, are now unemployed. But it's really going to start tomorrow, and for possibly the next 2 or 3 or however long it takes for these good people to find employment and get back to work. But it's obviously not going to show a payment, because the payment was not made, but it's not going to show any derogatory either.
But will that I wonder if that'll turn into a derogatory down the road. Anyway, it's going to be interesting to see how that plays out. And I think
they're asking it not to be.
Right. So they're asking it not to be, but we know how that goes sometimes, so we'll see. Okay, so I'm just praying that we're going to all wake up tomorrow morning and find out that it was just this big, humongous, giant April Fool's joke, and that none of this is really happening. Okay, so you had talked about FHA, VA, USDA, those payments being covered on the back end. What about Fannie, Freddie? Is the government stepping in to help cover that also?
So far, FHFA has not made an announcement like Jenny did. So we don't know. So if it's a government, meaning Jenny, it's going to go to Jenny. Jenny did on their website, and I forget what it says, Jenny Insights or Jenny it escapes me. I just have so much information in my head right now. But if you go to the Jenny Mae website, it will show you recently that they're saying, you know what, we'll cover the payments to the investors, okay? Because some
Yeah.
people, instead of putting in the stock market, are actually, investing in other investment vehicles, and they are expecting a return. So those payments
Right.
must be made. And so Jenny is saying, we'll cover it. We have an unlimited checkbook. If we need more money, we'll just go to the Treasury and they will make more money. But we will cover those payments. However, lenders, you are on the line to pay us back. At what interest rate, over what period of time, little vague, because this thing hasn't even been out for, 5 days? It hasn't even been out that long.
Right. But I think that's exactly what these lenders are looking for is, how can we cover these payments on the back end? So that's a really good question. I think it's a moving target, it sounds like. So we'll keep track of
Maybe
that.
we'll have more info by next week's webinar.
That's right. Okay, here's a good one, and this is very specific. What do you predict will happen with home prices in the next 12 months? Hope your crystal ball is really working right now. And they want to know San Francisco Bay Area specifically. So not to like zero in, but let's just, tell us, Dave, what will happen?
Okay. Guys, the things that we saw in 2017, 2018, 2019 are still there. In other words, do we have a housing shortage? The answer is yes.
Right.
Should builders then build more houses? I mean, think about it right now. I mean, can they? Are their workers sick? Are there workers at home? Do they have to get it? Is this an essential job? So unfortunately, we're behind more than 3 million housing units. And will that be resolved in 2 months? Absolutely not. So the appreciation for home prices is still going to be going up, whether you're in San Francisco, Honolulu, Houston, Fort Myers, Florida. It doesn't matter. The problem is nationwide. And the only thing that's going to be happening is increasing in value. Now, let's hope that these borrowers can stay in their homes to realize some of those profits, that when this is over and they have their job back, that they can come to you, get a loan to get back on track. But the value, the equity should be there.
Yeah, a house just went in contract around the corner from me, and it's jumbo, and they got 8 offers in the middle of all this. This was a couple of days ago. So there's definitely deals happening, that's for sure. Let's see. Oh, they're asking about construction lending. They are a construction loan officer, and they're wondering what you think construction lending will look like in the future.
Again, because we have need, I think construction lending will be, and let's kind of put the two, construction and reno. I mean, if you're looking at the prices, stock prices for like a Home Depot or a Lowe's, they didn't drop 30% like Disney did. They dropped maybe 5%, even in this stock market crash. So a lot of people are renovating their homes. There will be a need for construction. If she or he is a construction mortgage loan originator, guys, you have a good solid job after all of this just terrible mess is behind us. We're going to have to hold our breath for a little bit, but everything will return back to normal. Guys, I'm kind of thinking end of second quarter, maybe even as early as third quarter. We're going to see things pretty much behind us, and we will wake up like in that Dallas episode, if you guys are old enough to remember Dallas, where they woke up. Yeah, it was just a dream. Like you said, yeah, April Fools, just kidding, not really real. Right. You were just dreaming. You were drinking, the hard stuff, and So I really hope that every indicator out there, if people would leave stuff alone, it would correct itself. It would fix itself. I know that sounds harsh, but there's a ton of information that we just don't have time for. We've already been together for an hour.
Yes.
And there's
so we're going to do one last thing, and we're going to wrap it up. But this is the last thing I want to address, just because it's something that you don't want to wait a week to know. So would you advise your self-employed clients who own a company that's not considered an essential business to take out all the money on their equity line now instead of doing it in parcels, especially if values drop and the lines are frozen in 08? Thank you for being there for us. I'm grateful for all you. Oh, that's nice. All of you working on the webinar, not just you, Dave. Everybody, including Kimmy.
The only way we're going to do this is all of us together. You know what I mean? It's all of us together. It's not Audrey. It's not you, Kevin, and me, and it's not Megan. It's everybody that's on this show, presentation, webinar, whatever it is that we're calling it. It's all of you guys. You guys have been sharing some love. Let me give some back. It's because of you that we will make it. All of you guys that we're going to make it. Okay.
That's
so, wow. Do I pull all them? Case by case?
I know. So I am hearing about lines being frozen already. And so it did give me a flashback to 2008, for God's sake. Who wants that? And so, yeah, go ahead, Dave.
Frozen, but if the line still existed, they cut back on how much. I understand you're approved for 100 grand, but we're cutting your line in half. The most you can access is 50 grand. Yeah, I remember those.
Or closing it completely with no warning. That happened a lot. So do you think they're gonna? I mean, they're probably gonna go. People have value right now, so if they have value in their house, maybe they won't. But I think it's risky if that's your only resource is your equity line.
Yep.
Yeah. All right. Well, that's a tough one. Okay, just for the record, guys, we're posting a lot of these bulletins on the website, thecampsite.org, and make sure you renew your camp membership. Look for the information on the webinar that we'll be doing on Friday, the appraisal panel, which will be a great place for you to ask questions and get more information on how the appraisals are going. There are a lot more questions that we have, so we'll put them together and we'll keep them coming for next week. So we'll keep these notifications coming out. I know Dave is doing Facebook Live presentations too. So we'll just keep the information coming. And let us know if there is something you want to hear about or you'd like us to cover. So a big, humongous thank you to you, Dave Luna, Kevin Casey, Megan Jackson, who is the person who is handling all the technological, logistical stuff behind the scenes and who is invaluable. And best wishes to everyone and their families. We're so resilient. We're so adaptable, all of us in this industry. We're going to be just fine. So we'll look forward to hearing from you guys next time. Have a great day, great week.
Thank you. See you next week. Bye.
Bye.